Thanks for tuning in to Countdown. This is Bloomberg Quint and I'm Neeraj Shah. And the markets are flat as flat can be, but they have been mildly volatile in today's session. And if you just look at the volatility, it crept in after the press conference from the 4 Supreme Court judges started. VIX stepped up during this time and the Nifty came off during this time. Now clawing its way back up, right now trading very, very flat. In a few moments from now, of course, while we are talking about the markets right now, in a few minutes from now, I think the Chief Justice of India is going to speak as well. So do stay tuned because you don't want to miss that message on a day like this. However, what that pullback did is spoil the broader end of the spectrum, and therefore the market breadth turned adverse and has stayed, I think, lower. There you see this crisscross that happened somewhere around the same time that the market breadth has stayed adverse for the session today. The Nifty heat map will show you, I think, a fair bit of red. Even Stevens, you could probably even call this, and no top losers or top gainers. ONGC is a case in point. So upstream is doing well, yes. ONGC and Reliance and ICICI Bank. And if you look at the top contributors, they will feature there. But no big gainers or no big losers is the order of the day. Just want to mark the turnover and the volumes at this point of time. And you will see that compared to yesterday, of course, they will be substantially lower. But the BSE cash and the NSE cash headed towards those new normals of northwards of 5,500 and about 35,000 on the NSE cash and the BSE cash respectively. So that's something you need to watch out for in today's session. But as I said, while the large caps lying flattish with upstream doing okay, there's enough and more action in the broader end of the spectrum. Though Pradeep, I thought the BSE mid-cap or the NSE mid-cap index wasn't doing something too special. The top gainers, losers were fairly muted at the mid-cap end of the market today.
There are a good number of stocks that you can actually look at, on both sides, gainers and losers. Stocks that have been kind of moving in a trend, like Den Networks, for example. We highlighted this stock yesterday as well, and the entire media distribution space has been buzzing. The stock continues to be among key gainers today. Mahindra Logistics is another interesting stock to look at, and KEI Industries that we highlighted in the morning with a local brokerage coming out with positive report indicating a significant upside of around 30% from current level, and you can see the stock moving up. Subex is back in action today. Excel Crop Care is yet another stock that we have been highlighting for last 2 days, and stock continues to move up. Patel Engineering is the next in line moving up from the infra and construction space, and we'll look at it in detail. But Syntex Plastics is the key loser. This was the second quarterly number that came out after the restructuring or demerger of the plastics business from the parent Syntex Industries, and market has really not taken it positively. You can see the stock falling. The same thing happened when the first numbers came out, and similar sell-off is seen this time around as well. Dish TV, there are some concerns with regard to Videocon, and therefore we see a decline. Orient Paper remains at the lower circuit for second day in a row after demerger. So this is yet another demerger story which is not really playing out well. You have Oberoi Realty figuring among key losers as well, and two sugar names, Dhampur and Dwarikesh. Remember, this morning we had highlighted during the commodity update that the key commodity to really watch out for is sugar, because there was a significant fall of 3% yesterday itself and almost 7 to 8% over the last 7 days. And now the same is playing out on sugar stocks as well. Looks like sugar is weak, and so are sugar stocks.
Yes, indeed. In fact, I remember, Pradeep, starting off today's commodity talk early morning as well with what would be happening to the sugar commodities. So that's interesting as to what's happening thereof. Nevertheless, before we move any further, speaking of special voices, Sanjay Mukim of Bank of America Merrill Lynch is looking forward to the government's fiscal deficit trajectory in this year's union budget. On our special series, Thank God It's Friday, Mukim also explains why he sees a 2018 Sensex target of 32,000, which is a substantial, not a substantial downside, but a bit of a downside to the current levels.
I think in the short term, we have hit what I call peak macro. And this is to confirm what you said, is that on most metrics, whether it is the current account deficit, the fiscal balance for government, bond yields, inflation, a lot of the tailwind that India has had over the last 2 or 3 years seems to have turned. And as an aside, the equity market seems to take notice of that currently. But yes, we are in a slightly more difficult spot than we have been, and the policymakers and government will need to make some tougher choices in the near term. However, the positive news is that the government has, over the last 2 or 3 years, instituted major reform. And we all know of them, whether it is the bankruptcy court, the GST, the Real Estate Act. All of these, to my mind, are extremely powerful changes. This causes turbulence in the short term, disruption, and there are many words to describe it, but you get the sense. But the long-term benefits of these reforms are significantly powerful, and we will continue to accrue the benefits of these for years to come.
Right.
So in the extreme short term, yes, we've hit peak macro. The government has its hands tied tighter than it was previously. But in the medium term, there can be tailwinds that will arise from the reforms that have been instituted. So a bit of a mixed bag, really.
Right. Sanjay, I couldn't help but notice that you estimated the Sensex to be at around 32,000 by the end of December 2018. Does that mean that we're, and there are expectations that earnings could catch up? So does that mean that while earnings will catch up, we may not see as much of an up move for at least the large caps then?
That's right. And the reason I say this is that there are two variables broadly which drive equity prices.
Right.
One is the earnings themselves, and then there is multiples. In theory, multiples are correlated to earnings growth. So if you have higher earnings growth, the multiples should be going up. But what has been happening in India and perhaps the rest of the world really is that multiples have gone up outside of earnings growth. They've gone up on the basis of liquidity injections, on the back of a global equity rally really, and that is cyclical.
Right.
So while I agree with you that Indian earnings should improve in FY19 over FY18, in fact, we ourselves forecast an acceleration. Part of it is the economy doing better, part of it is just a base effect, because we've had a bad FY18-ish. Nevertheless, the risk is that the multiple itself turns down. So while sitting in India, we focus on India-specific factors, we focus on how the economy is doing, the multiple cycle is actually a bit of a globally correlated asset rally. So my worry really is that what we're not focused on, what we're all aware is happening, is the bigger risk to Indian equities this year than perhaps the earnings themselves.
What would you as an investor look forward to in the union budget?
Okay, first of all, the big number would be the fiscal deficit. And the reason I say this is because it has an impact on bond yields. If the government were to one time increase the deficit to, let's say, a 3.8 or 4, a meaningful step up from 3.2, then that means a significant issuance of bonds, which means bond yields go up.
Right.
Now, in theory, that should have a negative impact on multiples in India because your alternate cost of capital is going up.
Right.
Sector-wise, higher bond yields can exert pressure on certain NBFCs, for example, who rely on wholesale funds for their operations.
Right.
So there can be some sector-wise implications as well. That's the one big number really from the budget. Taxation-wise, yes, personal income tax cuts, if they were to happen, could stimulate demand and make some changes to the prospects of consumer companies, discretionary staples. Capital gains tax, as we discussed, could be another issue. But really, I don't see too much beyond that.
Okay, that was an important voice, Sanjay Mukhi of Bank of America Merrill Lynch. Well, that he was projecting some downsides for the index. I think if you take stock of specific stocks, there are a clutch of brokerage houses which are predicting some upsides for specific names. Mass Financial is a stock that is buzzing into it today for precisely that reason. It's up about 4%. Motilal Oswal has initiated coverage on the stock with a target price of 740 rupees. To discuss the prospects of the company, maybe pinpoint some assumptions that Motilal has made in their report as well. Let's talk to Mr. Kamlesh Gandhi. He's founder and managing director of the company. He joins us right now on the show. Mr. Gandhi, good having you. Thanks so much for joining in. You might be in a silent period. I don't know how much of a liberty you have in talking about numbers, but if you can just tell us how the quarter was without getting into specific numbers. Has quarter 3 shaped up to be a decent enough quarter for you?
Yes, we'll be giving you the exact numbers within next 10 days. But the quarter has been on the lines of our expectation. And let me share with you this, we have been doing throughout our journey right from 1995, that a very calibrated growth, focus on the quality, and thereby giving us decent return on asset and hence a decent return on equity.
Mr. Gandhi, if we look at your portfolio, you have been lending to the SME segment or the mid corporate segment, so to say. What kind of ups and downs have you seen over last 12 months? And isn't it interesting to note that this segment has come under significant pressure due to GST and also earlier due to demonetization? How was really your experience, and to what extent did it reflect into your asset quality?
We all know this year was a year of changes and disruptions, which can be, we all hope for the best, very encouraging in the medium to the long term. Talking to our approach, as I repeatedly tell, that we are very circumspect on selection of the clients whom we lend to. We always try to be their financial advisors, understand their business, understand their financing need, and then finance to them. And as a result of which we have been in a position to maintain a very robust quality of assets. We don't mind growth at the cost of quality. So our focus has always been quality. And as we all know, the problems were there with the sector, right from the no laws to adhering to various laws, understanding the same, coming to the terms that you will have to pay taxes.
The
so
NPA number stand, Mr. Gandhi? What is the NPA number for the last quarter, the latest reported quarter?
In the latest reported quarter, our NPA is less than close to around 0.5% in SME in particular. And as a product as a whole and as a company as a whole, it is close to 0.96% net NPAs.
And do you expect to sustain at the current levels?
Yes, very much. We are on track to sustain the same. And as I told you, it's a function of the fundamentals that we follow, that we give the right financial advice, extend credit where it is due. And just completing on what I was telling, that this was the year where this was a sector which had to adapt a lot. And they are working hard to adapt to it. And we see that within the next few quarters, let us hope that they adapt to it and the things comes back to the normal.
So the micro enterprise segment actually accounts for almost 60% right now. Will this change going forward, especially because two-wheeler is yet another segment which is one of the fastest growing segment for the industry and as well as for you?
See, going forward right now, if you see micro enterprise loans and small and medium enterprise loan, we look at it in a combined manner in terms of our approach, which contributes around 85% of our AUM. And going forward, if we find conducive atmosphere in terms of quality growth, two-wheeler, commercial vehicle, and the recently introduced product of used car will also start contributing. So the share of MEL and SME can come down a little.
How do you think the rising bond yields are going to affect you? What is your experience in terms of your funding cost? Has it gone up over the last 6 months?
As far as we are concerned, we recently raised around close to 460 crores in IPO. So the overall cost of fund have reduced because of that. But in terms of cost of borrowing, if I share that a majority of our funds is coming through banks, because we have an arrangement of 37% being sold to the banks under assignment route, where we get a door-to-door maturity and without recourse on us. And the rest is through WCDLs carved out of CC limits and the term loans from the bank. So practically we don't borrow in terms of the bonds from the capital markets.
And the bank's lending rates that you are getting, has it gone up or down, or what is the change over the last 6 months?
No, on the contrary, we have been in a position to maintain it and in some cases reduce it by some basis point. Because as you know that all the banks are very keen to fund to their existing and regular and good quality customers, having faced a lot of problems in terms of NPAs. So that is where we stand to gain because of our immaculate track record over all these years.
Mr. Gandhi, I think if I look at the Motilal Oswal note that has come out, amongst other things, the one thing that they speak very highly about and they believe will continue is one, your ability, and two, your relentless focus in generating high return ratios. Would you believe that over the course of the next 3 or 4 years, while you're in a high growth phase, there is an opportunity of your return ratios improving from where they are and improving meaningfully?
See, we have over all the years demonstrated our capabilities. They are talking about 17 to 20. And if you see our last 30, 35 quarters result, we have continuously improved on our operational efficiencies. We have continuously improved on return ratios. have maintained growth of around close to 30%. And we see no reason why going forward we will not be in a position to do it.
You would believe 30% growth for the next 3 or 5 years seems to be a distinct possibility?
Absolutely. Between 25 to 30% will be a distinct possibility.
And at the same time, you will improve or maintain your return ratios as well.
Correct. We will see. If you see our business model, the operational model, we are trying to become more and more competitive at the ground level, save on operational cost, save on the credit cost, and see to that ultimately we maintain our return on assets at the desired level, thereby generating good ROEs.
Okay. We wish you all the best for this and more, Mr. Gandhi. I know you can't talk too much in terms of numbers currently, but we look forward to talking to you post your results as well.
Thank you. Thank you so much.
Thank you for joining in today on Bloomberg Quint. That's Mass Financial with their sense of the numbers, but management sounded fairly confident of growing between 25 to 30% for the next 5 years and at least maintaining, if not improving, the return ratios. I think they were fairly confident of even improving the return ratios as well. That stock is up 4%. I think KEI is the other one which has done really well on the Motilal Oswal note. As in, Motilal Oswal came out with another note on KEI, wherein the target upside was about 40% higher or 45% higher, and that stock too is about 9% in trade. I don't think too many people came out with notes on Praj Industries recently, but it's a stock that is certainly in spotlight. It's fallen for the third time in last 4 days, but has had a really good run in the preceding few days. The interesting bit is Pradeep's chart shows a breakout from the consolidation. Now, Pradeep, what are the patterns that you are trying to show today on Praj?
Well, if you look at it, why I have picked up this stock is because it has managed to cross the 2010 high. That was actually the swing high on this chart on the long-term basis for the first time. We did attempt that in 2015 in third quarter, but it failed. But this time there is a real breakout. Stock is maintaining over those levels, and that is what really looks interesting. So this is a breakout on the long-term quarterly chart, and that is the point we would actually like to highlight. This is a quarterly chart that you see. If you remember, and maybe some people would still remember, what were the high levels in 2007, 2008, the stock was quoting above 250 odd levels, and from there it has corrected, and after a long drawn consolidation, it's probably bottoming out once again. If you look at it, the interesting pattern that we have been discussing, Neeraj, yesterday, the inverse head and shoulder, this also looks like somewhat an inverse head and shoulder. If you look at one shoulder here ahead and then a shoulder there in last quarter bottom, if you look at it. So maybe this could also be a strong case of an inverse head and shoulder, and you'll find interesting moves going ahead. What is also interesting though is whenever we talk about such bottoming out formation, whether or not a classical inverse head and shoulder or not, it's important to see what kind of volume pattern do you get in the upturn and the downturn. So if you look at this, till the time the stock was falling, volume remains below average. Stock moves up, volume also rise. You can look at it, in the entire uptrend, the volumes are rising, but when it falls, the volume again falls below average. And then once again, you can look at the movement in last quarter and this, or the last month and this month, volume is again high. So which means the upside is supported by good volume. So there is definitely, the tide has turned, or the scale is now probably in favor of bulls, looks like.
So Pradeep, you are saying that there is a breakout pattern that is visible on a really long dated chart.
Yes.
And typically when such a thing would happen, assuming that there is fundamentals backing it, the upsides could be substantially higher, because you're looking at the upsides clocked in the previous years, not necessarily in the previous months.
Definitely.
Is that a good assessment?
Yeah, that is. So normally you believe that, the gap between the neckline and the bottom, the head, is what actually gives you the price objective, and that is normally huge, because in this case the bottom comes at around 35 odd levels and the neckline is at 115, which means 80 rupees movement from the breakout point that will take you closer to 200 rupees. I won't really like to, stick my neck out and give any such target, but we'll definitely ask our experts. A conservative way of giving target also is that you measure the same 80 rupees you add to the last shoulder, the right shoulder. And from here, also if you look at it, probably 140, 150 is likely. So we are already at 125. So for short-term traders, maybe around 150 is the first target that they can look at. And 115, that is the neckline, now becomes an important support. On any decline, probably stock will find some support there and can be bought at around those levels. That is the theory and basic principles of this pattern.
Well, that's rather interesting. I was just trying to dig out what Praj Industries has done in the recent past. Remember, they've just been kind of trying to turn around the last few days, last few quarters, I might correct myself, Praj Industries. And they've been doing rather well for themselves. The fundamental performance hasn't been too bad. The chart performance or the price performance, of course, has been rather good too. So this is interesting. The other stock that I just thought we should bring out before we get in our guests, and I think we'll get in Somit in moments from now to talk about the other interesting aspect today, which is the oil marketing companies. But Pradeep, ICICI Prudential Life Insurance. Now, the reason I thought we should talk about it is because, Jay Bala was speaking about this chart pattern yesterday, but I was just looking at what ICICI, they're chalk and cheese, ICICI Prudential and HDFC Life in the same business, but the margins, the profiles, etc., are substantially different for both. However, having said that, it's a narrow space. There are not too many. There are now quite a bit of listed life insurance players, but not too many preferred listed life insurance players. This would be amongst the top 2 or 3 preferred names. This was amongst the first ones to get listed as well. But if you look at the last 12 months history, or the last 6 months, you will see that ICICI Prudential has substantially underperformed the other private player, a large player, which is HDFC Life. Now, of course, HDFC Life has got its share of fans. There are people who swear by that stock and the fact that you should only buy that even if it's expensive. But is there a case building for this one to play some bit of catch up to its earlier price and to the kind of move that has happened in HDFC Life since its listing? So if you look at HDFC Life, I think listed at about 280, currently at about 425. It is expensive. 455, okay. If you look at the last 6 months of HDFC Life, you will see that from the listing price, not the issue price of 280, HDFC Life has had a substantial move, but not so much for ICICI Prudential. As the 6-month chart would be a better depiction. It listed at about 280 and went up all the way to 455. That's not been the case for ICICI. That's underperformed meaningfully. Can it play catch up is the question.
Actually, I wish there was an insurance fund that was buying into all the listed insurance companies and I could invest in, because there is a very strong case for staying invested into insurance with a long-term perspective, because we know we are all underinsured probably.
Yes.
And there is a huge population out there which is not insured at all. So I think you don't really have to sell this stock, or you don't really have to go out hunting for arguments in favor of these stocks, but there could only be medium-term ups and downs. So the only question is whether you buy now or you hope to buy 50 rupees lower if it happens at all, or either way price can move. So that's not predictable. But the long-term case is very clear, I guess.
And I thought I was at the end of the curve, which has insured himself significantly or quite a bit. I was asked a question by an insurance company when they came that do you have home insurance, and I don't. And then the statistic that came out that 1 out of 1,000 Indians have home insurance. The remaining 999 do not have home insurance.
So that would probably be the ICICI Lombard that you'll have to buy it from.
Yeah, true, not life. But I'm just saying insurance as a category. So I'm sure life insurance has some telling statistics also to prove how underinsured Indians are per se. So
that's why I said, if there was a fund that bought into all these companies and more that will get listed, going forward, that would be must have in any portfolio, I guess.
Yeah, the only question would be at what valuations do you buy these? Because we've heard enough and more arguments from people who say that at the embedded valuations that the insurance companies or the life insurance companies are trading right now, you wouldn't want to buy them, are way more expensive than global companies. And there are equal number of people who say that those companies deserve to be more expensive than global companies because of a host of factors as well. Too many factors. We can get into all of them. and talk about them till the cows come home. But yeah, I just thought an interesting piece out here that somebody's pointed out that there is merit in buying ICICI Prudential Life Insurance as a trade. That was Jay Bala of Cash the Chaos who spoke to us yesterday.
So the trading case is definitely clear, as Jay Bala recommended yesterday, and there is a fundamental case as well as we discussed. Right now, I think there is some update on Unitech coming in. Okay, this is
There was Unitech.
actually flashing here.
So it was Unitech. I think Supreme Court has asked them, Pradeep, to deposit some
18 crore
monies.
So that is not much. If I read it correctly, it was 18 crore they have been asked to deposit, and if you could just look at this stock, well, nothing much is happening there. So let's move on. Signs of a pickup in global growth complemented with the constraints that we have seen have pushed the crude oil prices higher and higher over the past few months. But how much of that has impacted the oil marketing companies, the Indian fuel consumers? That is a big question that Somit Sarkar is standing by to answer. He's here with us. Somit, over to you.
So if you see in this chart, the pink one is a crude line, crude prices, the blue one is petrol prices, and the yellow one is the diesel prices. So in the last 6 months, crude has moved up significantly. It has moved from $47 per barrel to around $69 per barrel. And in the same period, petrol has moved from around 68 rupees per litre to around 74 rupees per litre, while diesel from 57 rupees per litre to around 63 rupees per litre. So on an average, if you see, Brent crude prices are up by around 45%. Whereas the petrol and diesel prices in a deregulated and in a daily pricing market has moved up by only 9% and 11%. Why so? Let's see. So in the last 6 months, the rupee has appreciated. The rupee has appreciated by around 1.3% in the last 6 months, and which has worked in favor of the consumers and in the favor of the oil marketing companies. Now, why does it favor the oil marketing companies? Because you need to spend less to buy every barrel of crude. Secondly, the government has lowered its income. Now, the government cut its income, that is its excise duty on petrol and diesel, by around 2 rupees per litre, and by around 2 rupees per litre. Thirdly, the gross marketing margins of the oil marketing companies had taken a hit. Now, around July, they were earning around 3.6 rupees and 3.3 rupees on sale of every litre of diesel and petrol, which came down to around 1 rupees per litre on sale of diesel and petrol. So they have clearly taken a hit of around 2 rupees per litre on the gross marketing margins to buffer the rise in crude prices. Now, along with this, it was also the slowdown in demand. Now, if you see the petrol and diesel consumption in India in 2015 and 2016 rose by around 7%. While the latest data shows that in the calendar year 2017, the diesel and petrol consumption has increased by only 4%. So from 7%, the consumption growth has come down to 4%. So this was also one of the reasons why the prices were not passed on to the consumers directly.
Wow. That's some development as well. Somit, I don't know if in your chats with all analysts or otherwise, do they lay out the reasons why OMCs are now no longer as much in favor on the buying list as they used to be? Would the gross marketing margins coming off be one of the reasons of the many?
Yes, it is, because if you see in that chart, if you could move on to the gross marketing chart, in July, on every sale of every litre of petrol and diesel, they were earning around 3 points, the gross marketing chart.
Gross marketing will come up on your screen. Yeah, this is one.
So on sale of every litre of diesel, they were earning around 3.6 rupees, which came down to around 1.3 rupees. And on petrol, it was 3.3, which came down to 1.3. So it's a clear cut that the oil marketing companies had taken on the gross marketing margins, which will also be reflected in the Q3 earnings by lower earnings. And also most of the analysts in their Q3 preview reports have said this as a reason that the oil marketing companies have clearly taken a hit on their gross marketing margins, because of which their earnings in the Q3 would be lower compared to Q2.
So one could say that this is basically some kind of hit that oil marketing companies have taken on their balance sheet rather than passing on the exact cost to the consumer.
Yeah, exactly. They lowered their income so that they need not to pass on the hike to the consumers.
Thanks, Amit. I think, Neeraj, that was a concern that several people have been talking about when oil prices started to move up, that maybe not be explicitly but implicitly oil companies could be asked to chip in and bear some cost.
Yeah, I would presume the whole game of buying into OMCs as these big winners was that we finally have something that had never happened, which is deregulation, right? And the move that happened in some of those reminded, I mean, I remember for years people just used to shun OMCs, saying that, hey, we don't want to touch them. Suddenly the last 3 years have been different. But I must say the last 6 months have been different from what's happened in the previous 3 years as well.
Prices are changing every day, right?
Yeah.
At the petrol pumps. So they had come off when, excise was lowered. And now once again, I think they're almost where they were, 78.50.
Yeah, 79 I think was the last price that I paid at the petrol pump recently.
Yeah, so
but,
nearly that.
Yeah, well, clearly the GMMs are not what they used to be. And that clearly means that there's some point to ponder there. Anyways, we'll talk about these. I think our experts will be joining us in moments from now to talk about the market, well, maybe OMCs, maybe Praj Industries that Pradeep was speaking about, and lots more. In fact, let's get in our first of the experts on board, Sarvendra Srivastava. He's independent market expert joining us on the show to talk about his sense of the chart. Sarvendra, good having you. Thanks so much for joining in. We have you in the studio for the first time, so welcome. What's the call on the index, Sarvendra? It's been a mildly volatile day today, but nothing really to rue a chance missed or otherwise. What is a trade on the index that you would be advocating?
See, my sense here is that now we are entering a very big even year cycle, and if you go and look at even year cycles, the way they have behaved.
Even year cycle.
Yeah, even year cycles. This is an even year. 2018 is an even year.
Okay.
And if I go back 40 years back in history, and from 1980s I start a Sensex plot and see what has happened in even years, there have been 20 cycles up, down. And especially even years are marked by cycles which are down. So we had 20 down cycles, 84 had 2, 86 had 2, and then every other year had 1. So on an average, on an even year, my data plot tells me that Sensex falls from the high average 30%. So, and it's been in 20 cycles, not a small ratio, it's 20 cycles that
20 out of?
20 out of 40.
40. So that's
38,
still a
38.
50% chance.
No. What I'm trying to say is out of 40 years, 20 years are even years. So I have done 20 cycles. Okay, 84, 86 are 2 cycles. So right from 1982, 84, 86, 88, 90, 92, without fail. Only I think 2014 and 16 were mild falls. So all that probably can get added because the average itself for 20 cycles is 30%. So you are still, so from the high, the potential that you could do a 20-30% kind of a move in an even year is like repeating every alternate year.
What
so
does
even odd, even year.
Our in-house chart expert feel about this?
Well, that's a novel way of looking at the chart, I would say.
Yeah.
I haven't really looked at that cycle. But what you mean to
so I would say
buy in 16, sell in 17, then buy in 18, sell in 19. Probably that's the kind of strategy one should follow.
Something like that. You buy odd years and you sell even year tops. And even years have given you the major tops. So it's definitely caution which is advised. And a 7-year cycle is completing. So what we started in 9-10, probably a 7-8 year cycle. If you go and look back all charts, financial charts, there's always a 7-8 year cycle which is repeating.
Okay.
So I'm saying that we are at the fag end of that cycle. Probably Jan, Feb is the month where you get major tops. So this till 14th of Feb. I think that's the cycle that you should be cautious about. So caution is also advised. Neeraj, the problem here is that people don't accept the fact that mid caps, when they top out, it is usually 20, 20, minus 20, minus 20, 10, 10.
We'll get there.
Yeah.
My first question is, so this is a theory that you have shared with us.
Yeah.
Let's accept it that it happens.
Yeah, it happens.
Now, how do you translate it into action? Because you have been on record being cautious. Maybe you are short in markets for several weeks now.
Yeah,
and
it's 7th, 8th week, from November 2nd week.
So as a professional trader, how do you manage your risk? When do you decide to go short, and how deep is really your stop loss level that you can sustain that position?
Very small, no? 10,500 is where we turn negative. We are still at 10,630, 650. So just
what's your stop loss?
Stop loss would be at 10,756 on a closing basis. Okay. Nifty would be around, I will take around a 2% hit. That's the minimum a trader can take. So a 2% hit is what I would take, 2.5% hit I would take and probably get out. So 756.60 is a closing only stop loss on Nifty. And I'm saying that if that is not violated, then probably on the downside you can slip back towards 10,000, which is the first target, and then towards 9,700 going forward next month, 2 months. So that's definitely a case. Caution is definitely advised. As I said, Jan, Feb is the turning point, if at all, in an even year, or else it will then extend to the third quarter. So if we are able to scrape through by Feb, mid of Feb, then probably we go to October cycles and then look at that. And then in the meantime, we will also probably try and go long a couple of 100 points
If
and
your
try and
stop
trade on the
loss
long
is
side.
triggered.
Yeah, if the stop loss is triggered, then we'll try and go long a couple of 100 points.
So Sarvendra, we'll talk about this a bit in detail as
Yeah,
well.
yeah.
But right now, since the markets are on, let's talk about the short term too. Right? One, is there a trade on the Nifty for the short term currently?
Yeah.
And couple that up with two ideas that you have for our viewers currently.
See, ideas I always carry 3, and Nifty also I'm carrying a trade. So I'm saying the trade I'll repeat again. What I'm saying that the first target would be 10,000 on the downside. Second
The
target.
short term, you're still going our short.
Yeah, I'm short only. From November 2nd week, we've been only advising shorts on the channel.
Fair call.
And I'm saying that we will probably end up close to 9,700 finally over the next 3 months if the trade goes right.
Okay.
10,756.60 on a closing only, a daily closing only is the stop
That's
loss
the
for this
stop loss.
trade.
Okay, what about stocks?
The strategy remains slightly aggressive on the downside. So first one is a buy, which is ITC, which is a defensive. So buy ITC for a target of around 280 is what I would recommend. Keep a stop loss there at 259.40. The remaining two trades are on the sell side. First one being DHFL. I think clearly negative divergences were there in the earlier top, and this bounce also seems to be failing on that one. My sense is that the stock could fall back towards 585, 590 from where it has kind of bounced right now. So sell for that target. 626.60 is what I would say is a stop loss for DHFL. And the last one is from the cement pack. Last time we had ACC. I would say this time I would like to short Ambuja. Look for a target of 255 on the downside for Ambuja and keep a stop loss there at 275.60.
Okay, so these are the strategies that you have right now on a short-term basis. We are focusing a lot on IT stocks because of the two big IT companies. One number is out, other is expected. How do you really look at the top 3 or 4 companies? Is there a trade there, short-term or medium-term, whatever?
No, absolutely. I think IT would be again within the defensive basket. If the market is falling, probably IT could definitely perform and outperform at least, if not more. So I think clearly looking at setups and especially large cap names, one name that stands out is TCS. It's been consolidating over the last now many quarters now, almost 10-15 quarters is a congestion on TCS, which is trying to get resolved right now. So the all-time high for TCS was around 2839. So 2840. Let's keep that round number. So when we clear 2840, I think then we are clearing almost 13-14 quarters of congestion and wanting to break out higher. So this was a similar pattern which Bharti had at around 350. And we know where Bharti is right now. So TCS is kind of mirroring that pattern. And if TCS breaks out of 2840, I think since if someone has bought lower, should hold. We had a long call at lower levels as well. But from here itself, I would advise to wait those 70-80 points. And if the breakout happens, then the stock is probably headed for 3,300, 3,400 levels going forward next around 6 odd months. So TCS would definitely be a long trade on the large caps. And within the mid cap space, we like Tech Mahindra, we like Mindtree. All of them have moved of late. But I think they can still do 10-20% higher from here, wherever they are.
Okay, Vishvesh Chauhan, Head of Quantitative Research at Monarch Networth Capital is also with us. And then, of course, we'll get to Anand Tandon with his thoughts as well. Vishvesh, good afternoon. Thanks so much for joining in. What's the call that you're taking? The index has bounced back quite sharply from the intraday lows. How are you approaching trades there? Couple that up, of course, with your stock-specific ideas for the afternoon.
Good afternoon, Neeraj. See, I believe more or less, everybody right now is, afraid of the market, and the market is not ready to come down. I'll tell you one simple statistic that in the last 2 years, whenever a put-call ratio has gone above 1.5, there is a 80% of the chances that market doesn't fall more than a 1% in the next 15 days. So right now you are having a 1.67 and 1.7 put-call ratio, which in my opinion, I have not seen that kind of a reading in last 3-4 years. So what it simply means that right now the put writers are so confident of their position, and probably it may act as some sort of a counter indicator for people, but I am reading it as a more of a directional. And what it means that probably if not a major upside, then you are not likely to have a major downside also. Now while I am making this statement, I am going again the seasonality factor that historically Jan tend to be a more volatile month, but for that matter I would say that let us wait for a 10,500 to break. If I am I'm talking about some sort of a bigger correction, then it has to first break some sort of a major support. So I guess in today's session also the kind of selling you saw on the back of some sort of a news, what has simply happened, that was absorbed. And as long as you don't break a support and you are adding some sort of a writing on the put side, I am not worried about the market. I would focus on the stock, and I think the stock specific moves are likely to happen.
So what are the stocks there, Vishvesh? Your stock ideas for the day?
Yeah, Vishvesh, what are your stock ideas for the day?
Pradeep, I think that right now in the banking space, the way shift may have, shifting from a retail banking to corporate banking, and in the private sector bank, I think the ICICI Bank is placed very well. I believe that there is a very good chances of stock giving you that 5 to 7% sort of a quick move. So with the 314 rupees stop loss, just a 2% stop, one can take a trading bet for the target of 330. And second is a torrent power. My sense is that stock has made an all-time high. After that, it is consolidating, and the way data is indicating in the OI front with the seasonality, I think 288 should be a wiser stop, and on the higher side you could see a target of 320.
Okay, a lot of stocks active. Fortis, for the wrong reasons, is down. So Fortis Healthcare is one that is correcting, but look at the gainers. Den Networks, Pradeep highlighted that Gujarat Pipavav has been gaining, First Source has been gaining. So enough number of gainers and losers on either and on both sides. Let's get in a fundamental view on the show. Anand Tandon joins us with his thoughts. Anand, good afternoon. Thanks so much for joining us today. There is some bit of resilience here, Anand. Every time the market is falling off, it is seeing buying coming in and taking it higher. I mean, it's not without reason that we are nudging 10,700. Are you still cautious, or do you believe an earnings recovery and a non-event budget could actually help the markets, if there is a non-event budget in the first place, of course?
So, am I cautious in the market? Absolutely. Do I believe that there can be an earnings recovery? Possibly. The probability is higher now than it has been in the last 4 years. Does it mean that, the markets have a lot of legs to run from here? I don't think so. However, I don't think it has got much to do with the budget. In the budget, we can screw it up. It is very unlikely that you can do anything positive here. The rally is happening because of international markets going up across all asset classes. And I think so long as that continues, by and large, we will also follow the trend. Domestically, as I said, we can do bad things to the market. I don't think we can do good things to it.
Okay, that's really interesting. What do you think can really go wrong, Anand? Like you mentioned, something you're talking about that can happen in budget or outside?
It can happen almost anywhere. You could, the number of things that can go wrong are always much more than those that can go right. For it to go right, lots of things have to fall in place. For it to go wrong, only a few things need to go wrong. So, the recent talk that we've had about of increasing justification for long-term capital gains sounds rather ominous to me. So that could be one thing. You take long-term capital gains away from equity markets, and you have to see a major resizing of portfolios. And but assuming that it starts from 1st April, you can assume that that you will see significant selling to just book for whatever has happened in the recent past. So that could be a simple one, but there could be a whole lot of others, especially in terms of the way the government goes around trying to control our spending and incomes. It need not be restricted to the budget. Already we are seeing that there is a demand which is still lacking, and if the government's expenditure doesn't move out quickly enough, or they worry too much about the fiscal deficit and don't spend enough, I think you will again find that there will be earnings disappointment coming through.
Okay. Anand, what did you make of TCS commentary? And if Infosys comes out with a half-decent set of numbers, is there more vindication that IT could be turning around the corner? I mean, mid-cap IT has already shown that. If large-cap IT too puts its foot forward, is that a heartening sign for IT investors?
Well, if they do show good numbers, obviously it is heartening. But clearly from the way that TCS mentioned, I don't think we are seeing anything much in the biggest sector, which is the BFSIs. The rest of the sectors like retail, etc., seem to be doing better, which is of course good news. But for large cap to get into double-digit growth, I think we are several quarters away, if that. And from here on, clearly the large cap IT essentially will be a stodgy kind of performer. I don't think that we have any visibility that you can get back to the heydays of 20% growth. That is far away. Even a 12 to 13% growth right now would be taken by both hands. That said, I think one of the key themes that I'm seeing turning around is that you're now looking at the export sector as the next phase, which is relatively underpriced. If you can buy stocks at 100 PE when they are growing at 30%, there is no reason why you cannot buy something at 15 PE if it is growing at 10%. The ratios look fairly cheap. So I think, export-oriented sectors, including IT, will actually continue to do well and maybe the theme for this year.
Okay, so that's the call on IT. One stock that Neeraj was just mentioning, Gujarat Pipavav, if you look at it, 12 to 13 times volume compared to the average volume at this counter is what we have seen today, and stock is up 10%. There is an HSBC report that talks about a target price of 174. Well, that is not too high from current levels, less than 10%. But looking at the kind of buoyancy and the volume that we see today at this counter, that's really interesting. Anand, is that a stock you track?
I think.
I think we have lost Anand for now.
Yeah, but I used to track Gujarat Pipavav quite closely, and I remember that in the past, they had a exit of their managing director as well, some change of strategy. They lost a lot of business to Adani Ports as well, and then Maersk decided to add some more teeth to the business, and which is why I think from 139 odd, because of the addition of a berth or thereabouts, it started doing well. I confess ignorance to the fundamental reason for today's move, but for the fact that there's a declaration that some mutual funds have piled onto it. But that need not be a reason for the stock to move up 10%. So maybe there's some other reason to this. But the only coincidence is, of course, that the declaration about Axis and maybe some more funds buying into Gujarat Pipavav, I think, came out in today's market hours, and which is why maybe that could be one reason why. But there's a lot that this one needs to do. Maersk India did very well for a large part of its early half of its career, 2012, 2013, when the port got taken, when Nikhil Gandhi sold the port to Maersk India. I think it did really well, and then just kind of fell by the side, so to say.
Okay, is there a technical call, Sarvendra? Have you looked at the chart?
Yeah, absolutely. I was looking. It's a stock in regular coverage, and the most interesting part about this chart and the stock has been, which I've been observing from 2015 onwards. This is one stock which has got a very good habit of, I don't know, at these levels, is it a value buy or not? I'm not the right person to comment on that, but clearly this is a stock which has got 80, 90, 100% delivery days pretty often. Every alternate day, right from 2015 onwards, has been a 80% plus kind of a delivery day. So
okay. You mean out of the total volume?
Yeah, out of the total NSE volume, 80 to, in fact, last 5 sessions, if I look, 4 sessions were almost 100% delivery days. 90, 100% delivery days is a good thing. Now, looking at a technical setup, which is at a 52-week 3-year low, the stock is being accumulated around these levels, 130, 150, whenever it is there. The deliveries are 80, 100%, so which is a good sign, and it's been happening for the last 3 years. So now, if it breaks out, I think it would be a very, very meaningful breakout, and this could be one stock which could go against the market itself, and even in a falling market could give you decent returns. So I would say that it's definitely a good buy. Right now, it has run up from 130 to 160, so let it cool off maybe 10, 12 points, and then probably you can enter. It will give you a very good risk reward, but this trade definitely will be a 12-month plus kind of a trade if you want to do, because the stock is not good for trading, because always the deliveries are going. 100% deliveries means you can't trade.
Well, I'm looking at the NSE. Not that I doubted Sarvendra, but just to corroborate, 84% delivery percentage in trade yesterday. So good going really for Gujarat Pipavav Port. And the same can't be said for Adani Ports, of course, for today's session. Gujarat Pipavav Port certainly doing well for itself. By the way, seeing a lot of, look at Den Networks though, Pradeep, I think you spotted it earlier. Den Networks is up 20% now. It was anyways doing well, and a sudden spike up. So 20%, again, I think the volumes are substantially higher than the 10-day average. So good going there for Den Networks. TV18 has some strength to itself, 6.5% higher for that one. So that's doing well. And I think Tata Global Beverages, after a period of some lull, has started to move up again. So look at Tata Global. I think that stock seems to be doing okay. Vishvesh, any thoughts on any of these 3 names? Maybe you can't give a call on Den Networks, but maybe Tata Global Beverages or maybe a First Source Solutions, either of these 2 stocks.
See, I think Tata Global Solution, in my opinion, is definitely something which has to be paid attention to, because from the 280 odd price, the move is coming where the percentage change of the bar is of a previous day was not more than a 1%, and after all this thing there was a declining volume. Now in today's session you have a more than a 6 crore shares trading in the futures, and on top of it you are breaking out with the 4% higher. My sense is that this is the exact momentum which traders would like to buy for a BTS or probably a couple of days. I guess the stock is heading for a 340 plus. You could keep a stop loss of 322 types, and probably you can have a target of 340.
340 plus is the target on this stock. But Jan Irrigation, if you look at this stock, has been moving in and out of band. Vishvesh, what do you think? Is it the good level to buy, or you'll wait? The stock has moved up quite a bit, and usually we see in the run-up to budget, Jan Irrigation does give you a good move.
See, I think here, Pradeep, you have to look at it slightly from a longer term perspective. In my opinion, the first time these prices are coming post 2014. The last time I remember correctly, 133 came, that was in the 2014 June. And now if you are going above that level with the rising volume, then probably you have to give benefit of doubt to the market as to that markets are having always the right prices. So from that perspective, if I have to guess, then my guess is that from a medium term perspective, the stock may have a potential to go till almost to 200 rupees, which is a very substantial move. So I have to guess something, then in my opinion, as long as it doesn't violate below 130, which happened to be the major resistance, I would like to buy on decline. I would like to expect a target for 10 to 15% from the current level. And my guess is that government focus on the irrigation projects may augur well for the stock, and from that perspective the stock is giving all the good signs. So probably in the cash somebody would like to buy, because FNO tend to be more volatile and in and out of band, like you mentioned.
Okay, watch out for Jan Irrigation. That's a remarkable move there. Wonder what if you've Sarvendra, since you're talking long-term charts, have you looked at the charts of Praj Industries? If not, if you can just look it up. Pradeep was just highlighting how it's moved up and broken some levels that it last met maybe 6 or 7 years ago.
No, absolutely. I think it's a nice bit of consolidation from 2008-9. So in fact, the 9 pullback, the initial pullback was in the region of around 122, and now that we are starting to move beyond that number and taking out a range of last 8-9 years, definitely, as I said, this could again, even in a falling market, there could be stocks which could be moving. So this can definitely fit that basket along with GPPL. That yes, a stock coming out of a 10-year range, having a bullish inverse head and shoulder reversal pattern. Volumes have been decent into this move, so definitely, and deliveries are also going not that great in terms of percentage, but definitely I think the stock has got potential, and if it stays clear of 115, 120 from here on, I think 140, 145 is near-term targets, and anybody wanting to hold for say 9-12 months probably could look at 160, 170 also as targets for Praj.
Okay. We'll wait and watch for that. For now though, while a clutch of stocks are moving around, let's bring in a fundamental story in the metal space. Remember, Tata Steel enjoyed the top position in the country for 11 years ago. I mean, for a long time, up till 11 years ago, JSW Steel substantially took over the steel majors capacity position, the numero uno position from FY12. What's been the factors at play here, and will Tata Steel be able to take its way back to the crown? Let's get in Nikki, who's done an interesting analysis on this. Nikki, good afternoon.
Hi Neeraj, it's going to be a tough fight, as you just mentioned. The history goes back 11 years. In 2006, if you look at the graph, which is shown that Tata Steel was at 4.8 million ton per annum as compared to your JSW Steel capacity of 3.8 million ton. So it was a neck and neck fight for both of these players right up till FY12. Now that's the year which is the differentiator, when JSW Steel capacity at 9.2 MTPA was higher as compared to that of Tata Steel at 6.8 MTPA. Now from FY12 to FY17, both of these players have doubled the capacity. If you look at the chart, Tata Steel has moved from 6.8 MTPA to 13, while JSW has inched up from 9 to 18 MTPA. Now at least Tata Steel has a plan in place. I'd not say a plan, maybe a vision in place, where it plans to double the capacity from 13 to 26 MTPA in the next 5 years, which is 2023.
What are the challenges, Nikki, to this? I mean, and can Tata Steel actually regain the numero uno position?
So that's going to be difficult. I'll explain why. Because first we say that JSW Steel is growing at a faster pace as compared to that of Tata Steel. Tata Steel's planned expansion to 18 MTPA in FY22 would be lower than JSW Steel, and also parallelly it has to add additional 8 MTPA of capacity in the span of next 5 years, along with your organic expansion. If you look at the chart back here that we highlighted for capex plans funds, you will understand that even after adding a good 18 MTPA capacity which is here, JSW is actually surpassing it at 23 MTPA, and it's only back in 2023 that the capacity of 26 MTPA would be higher, which requires an additional 8 MTPA for doing so. So what can we do for doing this? Now Jayanta Roy says that commissioning a large greenfield project in 5 years would be a huge challenge, as Tata Steel's ongoing expansion will be completed only by March 2022. So that's one challenge that Jayanta Roy, the group head of corporate ICRA rating, has highlighted to us. So ways that we can do that, Neeraj, would be by you're buying stress assets, be it like Bhushan Steel, Monarch Ispat, or for that matter, Electro Steel. Now, this can also be done in organic way. So both organic as well as inorganic action has to be in play to achieve the ambitious target. Now, what are the issues that the company might face? A would be a balance sheet constraint. Now let's remember the fact that the company is already sitting with a debt of around 80,000 odd crore, and for bidding the stress assets, it will have a fierce competition from all the other players. That's exactly the point which Rakesh Arora is pointing out. He's saying the impact of losses on books of Tata Steel will not wear off anytime soon, and given the balance sheet, the company is not expected to bid aggressively for the stress assets. That's what is expected from Rakesh Arora. He's saying it's going to be a difficult, kindly excuse this, this is going to be a difficult bet given the balance sheet position that Tata Steel has, and also the fierce competition that the company might face in the ongoing insolvency proceedings.
Yeah, that it certainly will. Nikki, thanks for putting all of that into perspective. So, well, that's a challenge for Tata Steel for sure to move back to the numero uno position. JSW comfortably holding that. The question mark only is what could happen to some of these stressed assets and whether there is value for a retail investor in buying those. Now, Anand, I think we have you back. But before we take that break, just a thought from you. Is there merit in owning a steel company, one? And if there is merit, because you believe the cycle might still be favorable, is there merit in trying and looking at some of the stressed assets which might become reasonably rewarding if a good hand comes in and if there's not too much of damage to the existing equity shareholders?
So this year, the earnings growth that you're seeing will likely be in corporate-facing banks and metals. Those are the two sectors which are likely to contribute most to the index earnings. So the short answer is that earnings, at least from steel, etc., is likely to be reasonably good, at least till the import duties are put up, are high enough not to allow the Chinese to sell. Coming to the second question about NCLT cases, I think, before it goes into NCLT, one can argue that there is a case to be made for companies to be bought, provided they can be restructured. My submission is that once they get into NCLT, I don't see why anybody should be buying the company. Really, they should be buying the assets and do a slump sale of the business, in which case anyone who's holding the equity may actually go to zero. Now, whether that happens or not is a different case, but theoretically, the fact that the secured holders of debt are going to take a haircut means that anybody else has to have value of zero. Yet the stocks continue to trade. So, obviously the market doesn't seem to agree to this point of view. But the short answer is before NCLT, you could speculate. After that, it is actually just hoping for the best.
Okay, so that's the call here, that probably buying into these assets would be a good proposition, and in that case, JSW or Tata Steel, whosoever acquires these assets should benefit. But last time around when Tata Steel wanted to become really too big and they acquired Chorus, they ran into trouble. This time around, let's see if acquiring assets within India turns out to be more profitable. And
but it won't be an LBO, I would presume. I mean, if indeed they go out and buy Bhushan, it won't be an LBO. It would be a much reasonable an amount they would probably pay.
Yeah, so that's what Anand is mentioning, that the lenders will take haircut and the prices would be much more lucrative for the acquiring companies.
Yes.
So it won't really be that big a burden.
Yeah, I think if just before we take that break, if we look at Yatin's piece on Monarch and the bids submitted by JSW, it speaks about, I think, a 75% haircut that the existing 50% to 75, I think 75% haircut existing lenders will have to take if indeed JSW is put to buy Monarch Ispat. So let's wait and watch. Anyways, let's take a break on that note. So much more to talk about. Come back, get you some final thoughts from Anand, Tandon, get you the Fab 4 stocks of the day, and also tell you what dealing rooms are recommending, and some closing strategies from both Sarvendra as well as Vishvesh Chauhan.